Some of the first terms new stock market investors run into are bull and bear. These terms are used to refer to market conditions, generally referring to appreciating or depreciating market trends. As simple as it is to understand the terms, the market conditions will have a major impact on your stock market portfolio and affect your investment plans going forward. Before we continue, please give this video a like so YouTube can recommend it to other viewers, and subscribe to the channel for more content. A common indicator of a bull market is an increase in stock prices. During a bull market, investors are more optimistic and have faith the rising market will continue for the long term. Investors that believe in rising markets are commonly referred to as bullish or bullish investors. During a bull market, a country's economy is typically strong and employment levels are high. On the other hand, financial markets can fall into a decline, and these markets are referred to as bear markets. Due to market corrections, which happen regularly and are categorized by roughly a 10% drop in stock prices, a true bear market is said to occur after a 20% decline after recent highs. During a bear market, investors are more pessimistic and believe the downward spiral in the stock market will continue. Investors that believe in declining markets are commonly referred to as bearish or bearish investors. During a bear market, a country's economy slows down, and unemployment rises as companies begin laying off workers. Even though it is easy to identify a bull market or a bear market by simply looking at the recent trends of the overall stock market, there are market characteristics that all investors should be aware of. According to Investopedia, there are 3 common characteristics. Number 1. Supply and demand for securities. In a bull market, there is strong demand to purchase securities and a weak supply of securities. This results in price increases for stocks. In a bear market, the opposite is true. There is an overwhelming supply of securities and low demands to purchase. This results in price decreases for stocks. Number 2. Investor psychology. Trends in the financial markets and investor psychology are interlinked. During a bull market, market sentiments are positive. Investors willingly participate and actively invest into the stock market in hopes of obtaining a profit. During a bear market, market sentiments are negative. Investors remove their money from the market and transfer them to more stable securities, such as savings accounts, CDs, and bonds. Investors will wait out bear markets and will return to the stock market when a bull market begins. Number 3. Change in economic activity. Because publicly traded companies participate in the greater economy, the stock market and the economy are strongly linked together. In a bull market, there is more money flowing to the stock market, and in turn the economy. People are more open to spending, thus creating a positive trend for companies. In a bear market, people are spending less and less money is moving through the economy. This results in the profits of companies to decrease, and that directly affects the stock price of companies in a negative way. So what can you, as an investor, do during a bull market or a bear market? During a bull market, risk is generally at a low. As an investor, you can purchase shares in a company with the hopes of the market continuing to climb, and you can generate a profit. If you choose to sell your shares, during a bull market, you shouldn't have any difficulties finding any buyers. During a bear market, risk is generally much higher. As an investor, you purchase shares in a company, hoping that prices will reverse and rise in the long run. Bear markets are favorable times to invest into defensive stocks. Defensive stocks are generally stable and remain resilient in their price during economic shifts. One example of a defensive stock is utility companies. Regardless of economic conditions, utilities such as water and electricity are still required. As an investor, the best thing you can do is stay updated on market trends and tailor your portfolio to weather the storms that come. There will be many economic storms that come throughout your investing journey, and all you can do is move with the ebbs and flows of the stock market. Make yourself resilient and plan for the future. As to date, all bear markets have ended. Play your cards right and you can turn any market into a financial win. That brings us to the end of the video. If you enjoyed the video or learned something new, please remember to leave a like, share the video with a friend, and subscribe for more content. Thank you for watching, have a great day, and I will see you in the next video.